Welcome to The Explainer. So today, we're going to pull back the curtain on that number you see in your 401k or your investment account. We're going to talk about what that number actually means. And, the answer might really surprise you.
Okay, let's just dive right in with a question that gets to the absolute heart of a huge misconception about the stock market. How much real, actual cash do you think it would take to create $148 billion in on-paper value? Believe it or not, the answer based on a recent real-world trade in Apple stock is just $25. Yeah, you heard me, $25. It sounds completely insane, but it's true.
So how on earth is that even possible? Well, it all comes down to this concept that Wall Street absolutely loves but doesn't always explain so well. It's called market capitalization.
Here's the key thing you have to get about market cap. It is not a big pile of cash sitting in a bank vault somewhere. It's just simple multiplication. It's the price of the very last share that was traded multiplied by all the shares in existence. That's it.
And that's the crucial point, right? The marginal trade. That one single trade happening at the edge of the market sets the price for everything. So if one share of Apple is bought for just $1 more than the last one, the company's entire market cap shoots up by a staggering $14.8 billion on paper, even though no new money actually entered the system.
Okay, to really get your head around this financial illusion, let's use a super simple analogy that makes it crystal clear.
Imagine there's an auction for 100 identical antique vases. The first one sells for $100. Instantly, based on that one little trade, all 100 vases are now considered worth a total of $10,000 on paper. But what happens when a few of the other owners try to cash in on this newfound wealth all at the same time? Well, the buyers vanish, the price totally collapses, and that 10 grand in perceived value, it just evaporates. Gone.
Now take that exact same logic from the vase auction, but scale it up, way, way up, to the entire US stock market. Just like with those vases, there is this massive gap between the market's on-paper value, its $60 trillion market cap, and the actual amount of cash that was invested to pump it up to that size. The real money that flowed in? It's just a tiny fraction of that big headline number.
So why does this gap matter? Well, this difference between paper wealth and real money, it becomes incredibly important and frankly dangerous when a whole bunch of people try to turn their paper back into cash all at once.
Let's just run the numbers on what seems like a pretty modest little downturn. If just 5% of the market decides to sell their stocks, that unleashes a wave of $3 trillion worth of sell orders all looking for a buyer. And here's where the math gets absolutely terrifying. At $3 trillion in selling is flooding a market that, on a good day, maybe trades about $500 billion. There's just no way. There's not enough daily buying activity to absorb that much selling without prices just plummeting. I mean, think about it. It would take weeks, maybe a month, for the market to chew through that volume. But the sellers, they can't wait that long. This is exactly why crashes are so severe. You get these forced sellers frantically looking for anyone to buy, and they start accepting lower and lower and lower prices just to get out.
So, are there any warning signs? What are the signals that this fragile system is starting to get stressed out? Let's take a look at a sort of dashboard of key indicators.
Experts watch these signals really closely. You've got the VIX, aka the fear index. It spikes when big investors get nervous. High margin debt is a huge red flag, because it means people have borrowed money to invest, so even a small price drop could force them to sell. And when you see fund outflows speeding up, that means a lot of people are pulling their money out at once, which creates this automatic selling pressure that can just feed on itself.
All of this, it all boils down to one fundamental and I think beautifully simple irony of how financial markets really truly work.
This one phrase, it captures the entire imbalance, the core asymmetry that drives market crashes. When you are forced to sell, maybe because of a margin call or because your clients are demanding their money back, you have to sell right now at whatever price you can get. But a buyer can always wait. They can always wait for a better deal tomorrow.
And this is exactly why the elevator goes down so much faster than the escalator goes up. When you have urgent sellers meeting optional buyers, prices don't just drift down, they fall off a cliff until they hit a level where a buyer is finally tempted to step in. It's not driven by logic or value. It's driven by pure desperation.
Which, of course, brings us all the way back to you. After understanding this illusion of market cap, it leaves us with one final, pretty crucial question to think about.
Is that number you see in your retirement account a statement of concrete wealth that you actually possess? Or is it really just a statement of collective belief? A belief that can evaporate the second everyone tries to head for the exits at the same time?